Well, good afternoon. Thank you so much for the invitation. It's my pleasure to be here, and we put together some material that I thought might be of helpful to anybody getting into the business. I've tried to focus on the questions that uh, George sent me, and also included some material that I thought would be helpful that I've learned over the last 50 years. So I'd like to start off with the first slide about what we are going to cover today. The first thing we're going to cover is the psychology of the market, inflation and interest rates, and the importance of stock market multiples. And then we're going to talk about company fundamentals, and we have as an example Schlumberger, Westrock, and International Paper. The final part will be how do you mentally prepare yourself to be able to focus and to be able to go against the crowd, which you have to do as a value investor. So my first slide is going to be, you either learn through wisdom and knowledge or suffering and woe, and you continue to suffer until you learn. So we have a choice. There's two ways to learn. You can choose wisdom or you can choose suffering. And the good news is either way you learn. Sometimes you just have to suffer a little more to get that extra lesson. Now, I chose to learn through suffering, not because I thought that was the best way after analyzing both ways. I was just ignorant of wisdom. And so getting into the market before you're prepared and knowledgeable can be a very painful lesson. But as I suffered through the 1968 and 74 bear market, where I was selling mutual funds, I was relying upon the wisdom and knowledge of the mutual fund managers. And what I learned through that experience is that if you didn't have a grounded philosophy, if you didn't have a discipline like many of the managers didn't have, then the funds did quite poorly. On the other hand, the managers who were disciplined, who were value people, and who were disciples of Benjamin Graham did very well and did even better than most of the other funds. So after many years of studying that, I became a value investor. And instead of sending the fund, I decided to set up my firm. Now, the first slide on page 5 is where we talk about crowd psychology. I'm going to give you a couple of classic examples, but I want to read you what Bernard Baruch wrote about the 29 story. These crowd madnesses recur so frequently in human history that they must reflect some deeply rooted trait of human nature. Perhaps it's the same kind of force that motivates the migration of birds. There seems to be a cyclical rhythm in these movements. A bull market, for example, will be sweeping along, then something will happen, sometimes trivial or unimportant or important. And first one man will sell, and then others will sell. And this is the most important thing you want to remember. When the continuity of thought towards higher prices is broken, stocks and markets don't always fall down because of fundamentals. Sometimes it's the psychology that pushed them up, and then the psychology pushes down. And so it's very important not only to study the fundamentals of the company, but also to understand the psychology. I cannot think of two better examples than the one I experienced in 1968 to 73. And I'm showing an article called Not a Bear Among Them. Now, this was really classical. Here they assembled the 10 best minds on Wall Street. They got them together in Barron's, and they interviewed all of them. And when you read the pages of how glowing they were looking at the market, it's kind of unbelievable to see what happened next. Basically, there were 10 of them, and there was not one who was bearish out of the whole group. Let's take a look at the next slide, and you can see what happened. Where I'm showing a PE of 1911, not a bear among them. That's when the article came out. Now, just think about that. Here we are at a 19 PE, which at that time usually, and even now, is usually associated with elevated markets. That didn't seem to bother him, and the reason was the psychology was very positive. The economy was doing good. Unemployment was 3.4%. Does that sound familiar? And everybody was enthusiastic, and more importantly, everybody was making money. All the junk was moving. Everything was going up. What could be better? And then not soon after that, the market took a dramatic plunge. And over 2 years, the PE went from 1911 to PE of 7.3. Now, the important reason I'm bringing this up, it's not so important that the market went down, and not so important that the multiple shrink. We want to know, why did the multiple shrink? So let's go to the next chart, and we can see here. Look what happened that caused this decline. At the peak, the inflation was 3.2%. By December 74, it went up 11%. And what I want to remind you is it can come pretty quickly, because in 6 months, from the peak of 73, in 6 months to June, from January to June, inflation went from 3% to 6%. So it literally doubled in 6 months, and obviously that got the decline going. And by the time it got to 74, we went from inflation of 3% to 11%. Now look what happened to the PE, 19 to 3. But here's the most intriguing thing. You would think that if the earnings went from 6.2 to 9.2 in the S&P, that's a 50% increase in 2 years, you would think that that would be pretty good. Matter of fact, all I heard during that whole decline, can't understand why the market's going down. The earnings are fabulous. The earnings are great. When have you ever seen the S&P's earnings go up that much? And yet, despite the increase in earnings, the stock price on your right-hand corner went from 120 to 62, which is a 48% decline. So let's really analyze this situation. We know that the market didn't decline because of earnings. We know that the reason it declined is because the inflation went from 3.2 to 11%. So that's an important thing to understand in your valuation, is what is the inflation at, but more importantly, what's the inflation going to be? So one of the things that we should always look for is, even though it's not visible now, watch for that inflation. It can come pretty quickly, and I'm going to show you a chart for the multiples. So that is the first thing that shows you the market psychology. It was swept up like Bernard Baruch, just an amazing thing. And of course, then it came down and everybody turned bearish. So now let's go to the next slide. And what we see is the opposite of the 68-72 market. Here, the market's down many years, from 68 to 74, that's 6 years. And everybody turned bearish because almost everybody lost money. And the Business Week article comes out, The Death of Equities, How Inflation is Destroying the Stock Market. Everybody was bearish, and everybody was bearish because of the inflation. Even Warren Buffett wrote an article saying how inflation is swindling the long-term investments. However, that did not prevent him from loading up on stocks, because while he was worried about the inflation, he knew that the stock prices were so cheap, they were discounting that inflation. It was a great opportunity to buy, and that's why we started the company 3 months before the bottom in September 74, because after studying value investing, after studying Benjamin Graham, to think that stocks were at 5 to 6 times earnings, that was a 16% yield. Even if you have 12% inflation, 16% pretty much covers yourself. So having the low PEs really gave it an opportunity. Now, the next slide after that is going to show you what happens, how cheap stocks are, and what a great opportunity is to buy at that point. And as John Templeton always said, invest at the point of maximum pessimism. And that's exactly what it is. Amen. That is definitely a great time to invest. And I'm going to show you that now. So on the next slide on page 11, you can see the death of equities was there. It went down about 7%. It bottomed at 98. And then from 98, it went back up to 212 in 5 years. So the bottom line of it is, with all the pessimism, with all the Business Week magazine covers and everybody bearish, that became the greatest bull market, and it never looked back. So the lessons are, understand the crowd psychology, understand that inflation and interest rates are a big part of that changes it, and remember this: Everything continues until the continuity of thought is broken. And that is something that I've remembered my whole career, the continuity of thought, because that sometimes is more important than the fundamentals. Now let's look at what happened after inflation subsided and what happened to the market as I just showed you in the chart. The inflation went from 13.5 to 5.4. So the inflation dropped 60%. The PE multiple went from 7 to 14, so the multiple went up 100%. And then the earnings went up, but not as dramatically as it was in the previous time, but still up 48%. But the market went up 210%. And the reason it went up is three reasons. One, inflation decreased, interest rates went down, earnings went up, and the market adjusted to it, and that was a 210% increase. So you have to understand how sensitive the market and multiples are to inflation. And later on, I'm going to show you a slide to show you exactly what happens at every percentage of inflation. But I just want to emphasize, always think about inflation, even if it's not apparent, even though it may not appear to be coming, and even though it may not happen in 10 years, somewhere along the line, you're going to experience that. And the reason that people never paid any attention to, I went through the statistics, and I found that the last time America had that kind of inflation was after World War I in 1917 and 18. So no wonder nobody was thinking about inflation at that time. It hadn't happened for 30 or 40 years. Well, we haven't had inflation for a very long time, but that doesn't mean we shouldn't be vigilant about it. Now, the next thing I want to cover is, from an evaluation standpoint, one of my favorite indicators as a stock market index is the value line composite. And the reason I follow that on the next page I'm going to show you is that value line uses a median PE, and that is so important because it smooths out all the outliers. So if you have a median PE, you're going to have a pretty good idea of the average. The S&P uses an average. So if you have real major companies like we do now, the FANG stocks, they can push that index quite a bit over the average stock. And people think the market's going up, but the average stock isn't necessarily going up. So what you want to do in your evaluation is you want to know what the average stock is selling for in the environment of inflation and interest rates we're in. And the reason you can use the value line data, I'm going to show you in a minute, but the other advantage is they use 2 quarters forward and 2 quarters back. And what that means is that it isn't as much projection as the S&P, which is only looking forward. And so it smooths that out. The most important thing is that there's 1,700 companies instead of 500 companies, so the large companies can't distort it as much as they would a 500 stock index. Now let's go to the value line index, which covers the period, and I started off with low inflation, which was at 72, 73, to high inflation, back to low inflation. So it's about 45 to 50 years. So if you look at this chart, other than the left-hand corner, which is the high inflation period, which we're going to cover, you can see the beauty about this index. It fluctuates between 10 and 20 times earnings. And you can see even in 2008, it bottomed at 2010. The red line is at 10. So what that does for you, instead of worrying about what is the stock selling for by using the S&P and the average multiple, you look at the value line index. It's published weekly. They update everything, and you get it on your desk on a weekly basis. Gives you a good idea what the average stock is selling for. And the bottom is 10, the top is 20, and the median is about 15. Now, why is that important? Because the first thing you want to do in evaluation is you're looking at a company and saying, is this stock better than the average, or should it deserve a discount to the average? So it gives you an idea what the multiple should be. If you've got a company that is materially better than the value line index of 1,700 stocks, you say to yourself, well, you know what? The average multiple should be about 15 at fair value. At the peak, it should be about 20. but this company is about 20 or 30 or 40% better than the average. So I'm going to move my multiple up 30 to 40%, and that'll give me a range. Now, that's not the only thing you use. That's a ballpark when you're looking at companies. When you get into the study of the companies, you can decide. There's many other ways to decide, but to get a quick look at a company, you say today the multiple is 18.4. The median is at this level is 17.4. So you know about what the average stock is, and then you can put a premium or a discount depending on how good you think this company is. If you'll notice over the long term, the worst case, which is the bottom, 4.8 to 8.6. But other than those 10 years, the last 36 years, it's been about 8.6 to 12. And then the expensive zone is 18 to 21. So it's a very good guide to guide you and to get you thinking. Now, here's another reason we don't use the S&P as our guide. The bottom line, the blue line is obviously is the S&P, and the red line is the value line composite. Now, as you can see, as we know that the value line fluctuates between 10 or 20, but look at the fluctuations on the S&P. It's gotten as high as 24. It has a 10 multiple, which got you into 25. A 17 multiple on the left-hand side shows you a 30 multiple, and then the 7, 8, 9.4. So you know that sometimes the S&P gets pushed way out of line, and if you use that as your average guide, you're going to be misguided. There's three things that this chart tells you that is very valuable. Number one, if you use the value line as a standard index, what it should be, and then you look at the multiple on the S&P, it shows you how far the market has gotten away by these big cap stocks. So the first thing you do when you see a premium on the market on the S&P, you know that the market is getting very valued and you're probably in a bubble. Now, what's also interesting, the minute it gets at the peak, it comes crashing down. So you can see that there was a multiple of 6.9. It came back down. 10.3 came back down. And the worst one was in the 99, 2000 area where the multiple was 17 times. So here the average stock, was about 12 to 15 times earnings. And the Standard & Poor, driven by all the technology stocks, was at 30. Well, some of the best years we had was in that right-hand corner where we were buying stocks at 12 to 13 times earning. The market was at 30, and then it came down. And while the market was coming down, the average stock was moving right along. So if you spot those exceedingly high periods, it'll alert you that you're getting into a bubble and things are going to be coming down. Now let's take a look at the right-hand column, and we can see that the market, the S&P today, is 3 multiples above the value line. It is, both markets are extended, but the value line is not in record corner yet. It'll be another 1.5 to 2 multiples. And the S&P is only at 3. The average multiple over the value line by the S&P is 1.88 at the bottom of your chart. So basically, let's just use 2 multiples that the S&P normally should sell. And when it starts to get up that, things are starting to get a little heated. Now we're at 3, which is not necessarily cheap, but it's not in a bubble. So my position on this is the market is extremely valued. It is due to interest rates, which I'm going to show you, but it is not yet at a bubble. It would have to go to 6 or 7 multiples to be in a bubble. We don't know whether it's going to go in a bubble. A bear market could start from any time when it's overvalued. But the one thing that's safe to say, it's not quite in a bubble. Now, let's turn to page 18. And now we're going to view the high inflation period. And the reason I want to draw this to your attention is because understanding what happens to multiples in high inflation and stocks is very important. You may never see this again, but I think sometime during your lifetime, you probably will. And if you don't, that would be great. So the worst case on the high inflation period on your left-hand side is from 4.8 to 6.8. And you can see in the high inflation period, which was about 9 years on your right-hand side, the median PE was 7.6. When you look at the value zone, and we describe value zone as 10 to 25% above the worst case. So the worst case is 4.8, the buy point is 6.8 to 7, and the expensive zone in this area is 8.3 to 9.9. Now, in a normal environment like we are today, the sell point is at the 20 level, and the worst case is 10. But in a high inflation period, the top is 10 and the bottom is 4 to 5. So it's quite a bit of difference, and the only difference is the multiples and the interest rates. So that's why I think it's important to understand that. Now let's go to the average inflation period, and that is the period from 82, 83, 84 to the current situation, or the 1980s. Now, if you look at this period, that's the middle years. It's from 1982 to 2008. That's about 26 years. And if you look at that period, you can see that the high end is usually around 19 and a half, the expensive zone. The value zone is somewhere between 12 and 13. And the worst case gets down to about the 10 area. So in an average period, you're probably going to get from 10 to 20 times earnings, and those are the last 26 years. Now, I'm sorry, the 26 years before 2008. Now, the real great period, which is what we've been in, is when you have low inflation and low interest rates. Now, take a look at this period. The bottom is moved up 2 or 3 multiples. The bottom over the last 10 years has been 13 times earnings on the value line. The peak has been in the 19 and a half area, and there was a little bit of time where it spent at 20 to 21. We are currently at 18.3. So the worst case in this environment is 12.9 to 15. The value zone is 15 to 16, and the expensive zone is 18 to 21, and the median BAA is 4.9. Now here's what's interesting. While the value line median in the middle period is 15, the value line median in a low inflation, low interest rate is about 17 and a half, and the S&P is about 19. So based on low inflation and low interest rates, this market is not overvalued. The problem is how sustainable is this area, and that's why the multiples may never get to where they should be, because they're probably not sustainable. But if you look at the market today, we know that the S&P isn't in a bubble. We look at the value line and say it's at 18.3. So if we went from 18.3 to 19.5, it would be about a 6% increase. If we went from 18.4 to 20, it would be about a 14% increase, and then we'd be in bubble territory. So basically, between being fully valued in this low inflation area and a bubble is somewhere between 8% and 14%. So when people ask me, what do I think about the market? Well, first of all, the first question is it going to stay this way? If it stays this way, it can go up another 8%. And if we go into a bubble, it can go up another 14%. That's about the best you can do. However, if for any reason the continuity of thought is broken, and that thought is broken because inflation is coming, interest rates are going up, and inflation is going up, and multiples go down, then you can go down a lot lower. So that's the thought process. All right, let's go into the next one. And I made this chart, and it's important to emphasize this. This is not a chart about interest rates. This is a chart about the premium over inflation. So when I look at the entire period, the premium is 5.4 over inflation. If I look at the low inflation period, it's 3% over inflation. So let's put this into perspective. We know that 5.4, 4.4, 5.4, and 3, the average is 4.3. So the average premium is 4.3 on the BAA. That's your first column. Now the current inflation is 1.8. So if we say what is interest rates would be if they were normalized, that means we would add 1.8 and 4.3 and we'd have 6.1. So look at where the interest rates are today. The interest rates today on a BAA, and you can run it across the aisle there, is 3.68. What they would be in a normalized way, if people thought that inflation was a little bit going to be up, is 6.1%. So you can see what happens to multiples if inflation picks up a little bit and it goes up 1%. Now let's just take that. Let's say we have 1.9% inflation. Let's say that inflation goes up 1%. That would put the inflation rate at 2.8. However, as you can see, during the low inflation, the premium shrinks from 4.5, 5.5 to 3. So now if we have 2.9 inflation, and now we have a rising premium because people are not as confident, the continuity of thought has been broken. They're saying, wait a minute, if inflation's coming, we should have a bigger premium than 3%. Maybe it should go back to 4. So if we just add 4.3%, 2.8, you're getting a 7% bond rate instead of a bond rate at 3.68. So you can see if the thinking changes, the continuity of thought changes, that can change very dramatically and make a big difference. And what I mean by the continuity of thought, if you look at the low inflation at 208 to 219, the premium is only 3%. Why? Because people feel the inflation is low and it's not going to go up, and so they don't demand as much of a premium. But if they thought it was going to go up like it did in the middle period or in the high end period, they're going to ask a 4 to 5% premium. So what happens is the inflation goes up and the premium goes up. And that all happens very quickly. And in 74, as I pointed out, the first 6 months, the inflation doubled from 3 to 6. Now, you can imagine what happens to stock market multiples if the interest rates or the bond rate, the BAA, goes from the 3.6 to 6 and 7. It's going to make quite a difference on the multiple. So be aware of that. I'm not predicting it. I don't know whether it's going to happen. Very few people do. But when it does happen, you need to react to it. Now, my next chart is to help you decide exactly where the critical interest in inflation is. Now, if we start off with zero inflation, you can see that the multiples aren't very high. And the reason they're not high is because if you only have 1% inflation, you're in a low economic environment, you might be even in a recession. So you're not going to get a high multiple. When we go to 1 to 1.5, you can see the multiples pick up on the S&P, but not on the average company. S&P is always going to get higher multiples at the early stages of inflation because they're the bigger companies, they have pricing powers, they have the ability to change things, and they have much more control over their business than the average smaller company. So when the beginning comes, the S&P companies will benefit. And that's what leads me to believe that there is a potential that we get into a bubble if all of a sudden the inflation picks up a little bit. Not enough to do damage, but to kind of perk things up, and then the multiple goes up. So now by the time we get to 2.5 to 3% inflation, we've got a multiple of 19. In my opinion, just by observation, my feeling is that 3% to 3.5% is kind of the sweet spot. That is where you have an ideal strong economy, you still have slow inflation, you have low bond rates, and the multiple can get to the higher level. Now look at this. If we were to go to 3 to 3.5 and the market reacted to the higher multiple, look how much higher the multiple on the S&P is compared to the value line. It's 8 multiples. That means at that time, we would be in a bubble, because when the multiple is at least 6 to 8 more, then you know that the S&P is in a bubble. So one of the things you want to watch for is when that inflation picks up, you might be able to see a big blow off in the market. I'm not predicting it. I'm not predicting inflation or the blow off or the bubble, but that's what could happen. But remember, the average stock doesn't have that ability to pass it on. So it's not going to get the benefit that the large cap and the S&P does. Now, as inflation gets to 3 to 5, over 3.5, you can see the multiples already come down 3 points. If we go to 4 to 4.5, it's down to 14.91 from 23. So you can see that you don't have to go to ridiculous multiples of inflation. When the inflation goes from the 2.5 to 3 to the 4.5, your multiple has gone from 23 to 14. That's quite a drop, 7 multiples. And then, of course, as the inflation moves higher, the multiples keep on going down. And you can see at the 12% inflation, that's the mean during the 74 area, or I'm sorry, 82 area. You had a multiple on the S&P of for 774. The value line medium got to 740, and at the bottom it got as low as 4.5 to 5. So the smaller companies will get hit very hard in that area if it happens, and the S&P will eventually shrink too. And that's why it went from 19 to 7 in 1974. So understanding these principles help you in your valuation of the companies. And I think that's a thing that I would want to know if I was going into the business, the historical aspect of this. So you look at the fundamentals of the company, you would figure out what environment you're working on, and then you place the multiples accordingly. Now, I have shown you an article that showed not a bear among them, the top of the market, everybody's bullish. It made the major financial publications. Then I showed you another article that showed you the bottom of the market when they were saying the death of equities. Now today in April 22, 2019, we have a new article. I think this is going to become famous too. And it's called, Is Inflation Dead? Now, I would like to ask all of you, seeing what happens when the continuity of thought is broken, like it was at the top of the market, and the continuity of thought was broken at the bottom, what is this magazine telling us? Well, I'm not gonna ask you the question. We can handle that in question and answer, but let me just give you some thought. What the magazine covers tell me, and not just one, but sort of the consensus of that, is that at some point the psychology goes to an extreme. And that's when the potential of the continuity of thought can be broken. Nothing has to change except the perception that investors are thinking that what's been going this way will eventually turn. And what would make it turn in this case? Well, if inflation goes up, that would certainly make them think. And then if the premium to inflation on the bonds go up, that would make them think. And I think that would break the continuity of thought. So the bell has been rung. We don't know how long it'll be. It could be 2 or 3 years. But somewhere along the line, at least from a no inflation period, the psychology is starting to reach a peak where there are a lot of people feel we're going to never have a lot of inflation. There's a lot of people, we're going to be like Japan, which has very low inflation for the past 20 years, and that we're never going to get inflation. And I wouldn't argue that because I don't really know. The one thing we know about the future is not too many people are good at predicting it. And even the ones that predict it, and sometimes I've even been right, it doesn't mean you're going to be right on your stock picks. So I wouldn't put a lot of weight on what anybody thinks about what's going to happen. But I would put a lot of weight in being prepared, being aware that there are things that could change. And when it does, valuations would change dramatically. Okay. We've talked about market psychology. We've talked about inflation and interest rates. And I wrote an article, forgot how many years ago, 10 years ago, I think, that said the most important thing in understanding stocks is inflation, interest rates, and the fundamental of the company. We have just reviewed inflation and interest rates. Now we're going to pick a company, Schlumberger, and we're going to look at the fundamentals because we've looked at the inflation, we've looked at the interest rates. Now we got to look at the fundamentals. So on the next page, we have a methodology that we do. We've looked at inflation, we've looked at interest rates. Now we're going to look at the valuation of money on the company. And here are the multiples or the metrics we use. Now, not all of them fit every company, but we try to peg each company with as many different metrics as we can to see if we can find a consistency. It's hard to put a lot of value on one metric, especially if it's earnings, because earnings can move quite a bit. The book value doesn't move quite as bit. The cash flow doesn't move quite as bit. But EV to sales is a pretty good, steady kind of metric, and EV to EBITDA. So we like all the other ones, but we try to find the most reliable metric. And it varies from different company. We're going to show you that. So let's take a look at Schlumberger. The first thing you look at a company is you say, well, what industry is it in and how's the industry doing? Because a lot of what happens to an individual company, it matters whether they have the wind at the back or the wind in front of them. So here we took the industry study and we used two different metrics that fit pretty good on the industry. This is the S&P 500 oil and gas equipment. It's an industry study and it's price to book. Now you can see on the left-hand side on the low end, usually the multiples don't get much lower than 1.1, call it 1, and the high at the low end is 1.7. Now, here's the way we decide how much that is. Take a look at the days, the number of days. In this study, the equipment sector has about 7,500 days. That is about 30 years. And now look how few days it spends at 1.1. Only 348 days at this low evaluation out of 7,500 days. That's only 4.6% of the time. That means if you buy it at this level, 95% of the time it's going to trade higher than that because it's only at that evaluation less than 5%. If you move up to the next level, you got about 1,300 days out of 7,000. That's a little more significant. But even that is about 25% of the time below and 77% higher. That's still a good deal. But anyway, we're at 1.1 in the 1.10, 1.7 category. So the current evaluation to price to book is in 1.36. And so we can see that we're in the 1.10, 1.70 area. It only spends 5% of the time there. So that tells us on a price to book, only on a price to book, this area, this industry is very cheap. Now let's go to the next one. I like this one better. It's an EV to sale. And if you look at EV to sale, same industry, you can see that at the low end, it's about 0.95 EV to sales to 1.2 times EV to sale. Now, if you look at that category, 885 days out of 7,800. So that's a very small percentage of the time, 11% to be exact. 858 days out of 7,824. It's about 11%. That means 89% of the time, the industry on an EV to sale sells higher than that. So that's pretty good in your favor. Now, here's the other thing I want to point out to you. It's 1.29, but if it would only go down a couple of points, we would be in the lower category because 120 to 145 is 74%. But if you go to the 0.95 to 120, and we're only at 129, so let's say it goes 9 basis points down, we would then be in a category where it's 89% of the time it trades higher. So between the EV to sale and the price to book, we are convinced that the industry by itself is pretty cheap. So that's a good sign. But now we got to look at the other thing. The thing we want to know is what are the main things that influence the company? Well, we know interest rates, inflation, we've covered that. We know that industry, that's an important point. But if you have a company that's tied to a commodity like Schlumberger is, and it's tied to the oil industry, we can't just ignore the oil industry because if we buy it at the wrong time, we could still get hurt, which happens. And so now the next thing we do is we've looked at the industry, it's cheap. Now we look at how Schlumberger is compared to the oil industry. And you can see that it parallels it pretty well. So unless oil is cheap, this still may not be a good idea, because even if the industry is cheap, if the price of oil is going to drop dramatically, you could still have some pressure. So if we look at the industry and we look at oil and we look at the price of Schlumberger, it's oil is cheap, industry is cheap, and the stock is down quite a bit. So those are all good indications so far. Now we go to the next price, and we just show you a price of Schlumberger where it is. Now that chart doesn't tell you anything. All it tells you, it's down dramatically, but it doesn't tell you it's cheap. It doesn't tell you the industry is cheap. It doesn't tell you oil is cheap. It just tells you where it is. So let's move on. I just want to show you that picture. The next thing we do is say, okay, let's look at this company and let's identify the low points, which are 5, if you count the right-hand side, which we didn't circle, but we should have. And then the high point is 4 points there. So now what we do is say, okay, what happened in these bad periods when the stock was way down? What were the evaluation? What were the metrics? And what was the reason it was down? Well, the beauty is you can go into the value line, and they publish a quarterly statistics on every stock, 1,700 in the company. You can get 5 or 6 value lines. So the first value lines show you 15 years history. If you get another 4 or 5 years back, you can go back as far as the company goes, and you can read their commentary. You can read the statistics. You get a good idea of what's happened to this company. But let's take a look at what we do. The most important thing, and we have used this principle, which we got from the Benjamin Graham, the margin of safety, which I will explain later. So we spend a lot of time thinking, okay, what are the metrics at the bottom? So let's do this. We've circled the bottoms, and now let's take a look at them. Let's move the slide to the next thing. Now, in your left-hand corner, I'm going to show you the dates. And you have a low multiple. This is EV to EBITDA. This is a low multiple of 786. The next low period was at 857. That's the second point at 1998. The third point is in 202, that's 921. The fourth point is at 550. And by the way, we use a weekly price history instead of a daily, because the only reason you got a 550 is this one we did. We wanted to see what that low point was, so we did it on a daily basis. But normally we use weekly, and the 550 wouldn't even show up. But because this was 208 and it was an extreme spike down, it got down to 550. But the average is about 6. So let's go on, and then we have the final one today at 899. So what we do is we take those low periods, we average the multiple. I'm going to show you that on the next page. So here's the low multiple, 95, it was 7.4 times EBITDA. 98, it was 8.6. 202 was 9.1. And in 208, 209, while it was technically 550 for a few days, 6 is probably about as good as it gets if you took a week's average. So you don't want to get the spike too much where you miss it. So now we take the lowest multiple, which is 6.1. We take the 3 lowest, the average of the lowest 3 years, which is 8.4. And after analyzing the company, after looking at the multiples and looking at the company and looking what would be a good return, we make little adjustments. And so we conclude that our worst case, instead of using 6.1, we're going to use 7. So 7 is, as you can see, pretty low because the average is 8.4 of the low. The median is for the 25 years is 9.1, and we're going to use 7 as our low point. And that is 7 times EBITDA on your right-hand column. So that gives us the multiple of 7.4. The buy point is usually 25% above the worst case, which means that we want to start buying a little bit higher because not every time the market goes to the extreme low, as you can see, and we don't want to miss it. So we start at 25% above the buy point. Now, if we want to really refine this, which we'll do when we show you the margin of safety, we don't buy a full position if we think it could go lower. We might buy half of the position or 2/3 of the position and then wait if it averages. But certainly at 840, you're not going to go wrong buying it there. Fair value is halfway between the buy point and the sell point, which I'm going to show you, and that's about 11. Now let's go at the high side. So we figured out what to use in the EV to EBITDA, 7 times EBITDA. Now we take every other measure, EV to sales, we figure out the average for that. Free cash flow, we figure out the average for that. And then on the PE, we figure out the average of that. So we do the same thing that we did with the EV to EBITDA on all the metrics. Now we take the high side. So on the high side, we have 17.3 as a multiple of EV to EBITDA. We have a 24.9. We have a 15.7 and 11.19. We have a peak of 24. And the average of the 3 highest years is 14.9. The median is 15.2. I'm sorry about that. So we use as a sell point 14, which is lower than the median, which is right up with the 3 highest years, but certainly not near a peak of 24 or 15 or any of the other ones that are there, like 17. So now we have got the structure. On an EV to EBITDA, it's 7, 840, 11, and 14. And then we do the same thing with EV to sales. So let's just go through EV to sales. 1994, 1.6. 1998, 1.8. 202, 1.9. 208, 209, 1.9. The lowest is 1.6. The next 3 lowest years is 1.9, and the median is 2.2. And so we can see on an EV to save, the worst case is 1.6, which is very low. The buy point is 192, and the sell point is 3. So we do that with all the different multiples. So now we're ready to look at our stock. Now, I just want to show you this from a historical perspective to see how great this works. So if you look at the EV to EBITDA, we saw the low and the high. And you can see that at this point, the bottom line is 8.8. The EV to EBITDA today is 10. And you can see that only one time did it really drop below the 8.8. So when we use 7, you can see that that's pretty good based on 25 years of history with all kinds of different environments, all kinds of different problems. So we feel that's a pretty good way. Now, here's another metric that I think is consistent in this company. Schlumberger EV to sales. Now, look how consistent the bottom line is. The bottom line is 1.82. So that is the bottom of all the time. And if you bought it at 1.82, you'd be buying it right at the bottom for the last 25 years. So when you have an EV to EBITDA at 7 times, when you have an EV to sales at 1.8 times in this company, you have 2 things that are pretty consistent. The other ones are pretty good too, but these are the best ones in this particular company. Now we have the structure for the company. On 123.20, we did this. The price was 37. It's probably around 34 today. The worst case is 26 based on all our multiples. The buy point is 32. The fair value is 43, and the sell point is 55. Now, in the left-hand corner, if you look at EV to EBITDA on 220, the worst case is 7 times the EBITDA, which is 23.7. If we use EV to sale, the worst case is 1.65, which gets you to 29. If we use price to free cash flow, we get to 25. If we use PE of 15, we get to 24. And if we average all the worst cases together, we come up with 25.7. And so we make, on the left-hand side price structure, we use 26 as an EV to EBITDA worst case. So that's our worst case. That's about how bad things get. And then we use the same thing with the buy point is 30. On an EV to sale, it's 37. On a price to free cash flow, it's 30. On a buy point to PE, it's 29. The average is 31. And we do the same thing, and so we average it out, and the worst case is 26, and the sell point is 55. Now we move it forward each year where we think the market could go when the company recovers and all the work that we do. And you can see at the bottom line that today in 220, this stock should be selling at 55 and it's selling at 34. But if you go to next year, it could be worth 59, 66, 73, 78, and in 5 years, we think it could be worth $84. Now, when you buy it at 32, you can see the only risk you've got is down to about the 26 area. And the stock right now, based on all valuations, is got to be worth $50 to $55. Now, we're going to take the margin of safety that Benjamin Graham wrote about. And this is an important part to understand. He said the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. And I would say, amen. Let's go back to that same chart, the previous page, and you could see that in 220, we think the stock could be worth $55. So if we're buying it at 32, we don't have to be so accurate about what it's going to be worth in the future. We know it's going to be worth at least $55, even from going from the very worst place, but it could be as high as 84. But we don't have to be that accurate in the future the cheaper we buy it. Now let's apply Benjamin Graham's theory, and we've modified it a little bit, but I think he would agree with it. And here's the way we do it. We have the structure of Schlumberger. The worst case is 26. The buy point is 32. Fair value is 43. And the sell point is 55. Now, let's go to the left-hand corner and you say, if we buy it at 32 and it goes down to 26, which is our worst case, we have a risk of 18%. But if we go to the one-year sell point of 55, that is still an increase of 71% or 72% with a margin with a reward to risk of 4.81. Now, here's where the margin of safety really comes in. Let's say we're a little nervous about it, or we have enough of it, and maybe we want to cut our risk because we already have a lot, we're averaging, and whatever the reason is, we're happy to buy it at 32. But if it got to 30, now the risk to 26, if you buy it at 30, your risk goes from 18% down to 13%. The upside is still the same, so your increase goes from 72% to 83%. That's already quite a bit, but look at your reward to risk. Your odds of making more money is 6.3 to 1 instead of 4.8 to 1, just by $2. So that is why it's so important to be disciplined. You can cut your risk and you can increase your return, which increases your odds. Now, if you get to 28, which is only 2 points above the worst case, you got to be pretty cute to be able to execute that. But if you really want to wait until the final bottom, and it does hit it, I'm not even talking about 26, I'm talking 28. You're only down 7% to the worst case. It's hard to miss. The upside is 55. And now the upside goes from 71% buying it at 32 to 96% increase. So you really you reduce your risk and you increase your reward by buying closer to the worst case. And that's why I tell all our analysts, I tell anybody who here, spend your time studying the worst case. If you can really get that down, and it's amazing how consistent the market is, there is a wisdom in the market at the extreme, because somehow at the extreme, things do turn, the psychology turns, the continuity of thought turns, and it moves on. So once you got the worst case figured out, it makes it a lot easier to know where you're going to buy your major position, where you're going to average, and where whatever you have left that you want to buy, this is the time to buy. Now let's look at one more chart. That is your reward to risk. The time, I forgot. What's the time?
You're almost 1 hour.
Huh?
You're almost at 1 hour.
Okay, so I'm going to skip the next point because it's the same thing, only it's a 5-year sell point, and you can see the same thing. We have to move on because of the time element. And I do have a company called West Rock and International Paper, and why we chose one over the other. Unfortunately, I'm not going to have the time to cover those, but I am going to use the last part, and that's to be mentally prepared for this business and for this career. And I want to take a few moments to cover that so we don't dip too much into your time. So I will start off with the statement that being mentally prepared on page 51. Now, one of the things I've learned, and it's the most important thing I learned in my life, is to be totally focused on the truth and to follow the truth wherever it leads you, even though sometimes that might not be into your advantage, because it always pays off in the long run. But the thing that interferes with great thinking and clear thinking and making good judgment is to get control of your emotions and your mind. And that allows you to stand apart from the crowd. So I want to read you this quote by Dr. Carl Menninger, a great psychiatrist. The voice of intelligence is drowned out by the roar of fear. It is ignored by the voice of desire. It is contradicted by the voice of shame. It is biased by hate and extinguished by anger. And most of all, it's silenced by ignorance. So you can see that the voice of intelligence gets drowned out, irrespective of how it is, if you have these conflicting emotions. So the most important thing is to get control of that. And the most important thing I learned is to have a principle in life. This idea came to me when a 19-year-old girl smuggled me through the German lines. I was born in Holland. My folks were in Auschwitz concentration camp. Very tough time. And this 19-year-old girl risked her life to save my life. And all while I was growing up until the time I actually went into psychiatry treatment, I couldn't figure out how somebody could risk their life for me, somebody they never even knew or met before. And I had a great deal of thought about that, never could figure it out. So I asked my psychiatrist, his name was Dr. Rameljak. He said, oh, that's very simple. If your life is more important than your principles, you will sacrifice your principles. If your principles are more important than your life, you'll sacrifice your life. Well, the way I apply it to those of you that are going into corporate, you may not have to sacrifice your life for your principles. There are going to be many times where you might have to sacrifice your job, or you might have to sacrifice angering people in the company or your boss because they don't want to go along with it. But I assure you, if you stick to the principles, in the long run, it's going to pay off. I'm going to show you why. So getting control of your thoughts and emotion, truth, lying, anger, and ego. The most important thing, which was developed by Fyodor Dostoevsky, he wrote The Brother Karamazov. In it, he said, when you lie, you lose the ability to discern the truth. Now, what could be more important to an analyst is to be able to discern the truth in yourself and others. Having lied, you lose respect for yourself and others. Not respecting anybody, you lose the ability to love. And without love, all that remains are the base pleasures of life. Indulging in all the base pleasure of life, you become morally depraved, and it all started with a lie. So the first order of the day is you try to become as truthful as a person. And what I can say to you, neuroscience has now proven that even white lies affect your thinking and your body. And you can Google neuroscience and talk about lying, and they'll give you all kinds of information. Take my word for it. There's a lot of evidence that. So making sure that you become a truthful person and a truth seeker is one of the greatest ways to control it. The next thing that affects emotions terribly, and I had that problem myself, is the anger chart. Now, if you have anger and resentment and irritation and you express it, if you say something that makes me angry and I say, look, Bob, I don't really appreciate you saying this and so forth, you get it out of your system, whether they like it or not. You have direct expression and you don't have a problem. But when you depress it because you want to be polite, you want to be politically correct, you want to please everybody, then you're going to create more resentment because you're building it inside. Eventually, it goes into the subconscious. The subconscious directs it as an expression, and you develop depression, addiction, compulsive behavior, alcoholism, smoking, gambling, eating disorder, sickness. You go to the prisons, and I will guarantee you that the majority of the people of problems are due to this cause, because you can see all the different problems anger causes. There is one other quote that I really love from the Bhagavad Gita, and that is, you can go back, this was written about 100 BC. From anger arises delusion. From delusion, loss of memory is caused. From loss of memory, the discrimination facility is ruined. And from ruin of discrimination, he perishes. In other words, you lose your ability to discern. And that's a very important thing. The last thing, which we'll wrap it up with, is ego. I think when you look at anger, lying, and ego, I don't think anything else could be more destructive to a human being. So David Seabury, a psychiatrist around 1937, wrote a great book about the subject. And he said, the only way you learn to control your ego is by not feeding it. Every time you do something that's ego-orientated, you develop a pattern, a habit, and you have a greater need for doing it. So the best way to control your ego is try not to feed it. Whenever you have a compulsiveness to say something great or make yourself look better or take credit or whatever it is with the ego, you try to stop it, and that changes the habit and the thinking. When you control your ego, you gain humility, and the last lesson of culture is humility. And if you don't have any, then you have one more lesson to learn. So developing humility is the thing that allows clear thinking. In summary, I would say that controlling your emotion through truth, anger, and ego is a very important practice. In order to practice these principles of being in control of your emotions and thought, I recommend that you study the subconscious mind. As a hobby, I've been studying it for 40 years, and what you can do with that is truly amazing. If you develop the ability to control your emotions and thought, you will create the ability to see the truth and reality, as well as exercise good judgment. This will allow you the strength and character to go against the crowd instead of being part of it. If you develop these principles, it will not only help you in your investments, your career, your philosophy, but more important, your life. And following these principles, you help your profession, you help your family, and you help your friends. So in closing, I hope these thoughts will be of benefit to you, and I thank you for your time. Thank you. I guess now we're going to have questions and answers.
Hi, Arnold. Thank you again for coming in and speaking to us. And thanks as well for providing us with your book of quotes. I kind of wanted to ask you about one quote in specific, if you don't mind. On the very first page, you talked about Socrates and his quote about employing your time reading to learn about other people and from their experiences. I'm just curious, who are some of the people you've learned about and what their experiences are and how that's shaped your philosophy on investing and life in general?
Okay. Well, that is a great question. And let me just start out by saying that my hobby is collecting quotes. Those in the book are about 300 of my favorites, but I have about 5,000 in my file. And the way I found through accident, the best way to find people to read and study was every time I started collecting quotes, and I mentioned that in the beginning of the booklet, why I started collecting quotes by the quote, "I will prepare myself" by Abraham Lincoln, which was just turned my whole life around as far as business goes. So what I started doing is collecting other quotes. And what I do when I find a quote that keeps popping up, whether I cut it out of a newspaper, a magazine, or a book, or wherever it is, when I see a person that has good thoughts and great insights, then I'll look up who that person is. And if that person has accomplished some of the things that I'm looking for, then I'll order his book and start reading his books. So the books that I came up with aren't necessarily books that were prescribed in college. They were books that came to me through the quotes. And I have a whole library of books now, and I even have about 2 shelves of books I haven't read. So they're piling up. And so what I did a couple of years ago, I hired people who I hired to read a book for me and make me a book report. I pay them for the time to read and the book report. And this gives me a chance to screen a lot of books, because sometimes you get a book and it may not be worth the time to read it. By reading a book report, I can take 3 or 4 book reports home in the evening and flip through them in probably an hour, and I get the essence of the book. And if I think the book is really great, I'll read the whole book. And if there's a couple of chapters that are particularly good, I'll make copies of the chapter. So this allows me, as far as reading, it depends on the subject. But in the business sector, I think that the obvious books are the books written about Buffett and Graham and Buffett's annual reports. And there have even been books written about Buffett. And so we've read all of those. And so that's one sector. And Peter Lynch comes to mind. Seth Klarman comes to mind. I've got a whole library full of business books. I couldn't give you all the authors, but if you take the great money managers, those are the ones I'd read in the business. In the spiritual part, I was very impressed, even though I grew up Jewish. It was one of my bigger conflicts, which the truth, that quote came to me, which I have in the quotation section and the philosophy section, is that I was struggling between what was correct between Jews and Christianity, and is Christ the Messiah, and so forth, and coming from a Jewish home and parents going through the concentration camps. I don't think they would have thought highly of me switching to Christianity as being Jewish. But anyway, the way it was resolved is I struggled with it for 3 years, but about 6 months into the struggle, I was struggling with, well, what is right, and what if I have to go this way, or what? And a thought came to me, which has influenced the rest of my life, is it just flashed in my head. It says, if you want to follow the truth, you have to go wherever it leads you. And that's what it came. And then after I thought about it, it says, yes, if you have to go wherever it leads you, it may be consequences, but you have to pay the consequences if you want to follow the truth. So the end result was, if you want to follow the truth, you go wherever it leads you, even though the consequences may not be particularly advantageous. However, if you follow the truth, in the long run, you'll be better off. So I read all the religion. I read Buddha. I'm very close to that teaching. I read Hindu philosophy. I read Christianity. I studied all the biblical prophecies. So in there, I would recommend all the major religious books, and I have some specific ones. In the philosophy department, anytime you read the Greeks, Plato, Aristotle, Socrates, and especially Socrates' whole specialty was to search the truth. He didn't care about anything else but the truth. And the Greeks said, know thyself. And I think, and by the way, I've gone through 5 years of therapy myself, so I learned that to understand yourself and understand what motivates you, and understand that what happened to you when you were a child could affect you the rest of your life, unless you clear it up. So I even went through hypnosis, where you get regressed back and you can see scenes out of your childhood, you can clear them up, and you can move on. And I practice hypnosis and have done it for over 35 years. And so that's a very good discipline. So there's many different books, but I have one book that is my ultimate favorite of everything. And that is a book called Poverty to Power by James Allen. And James Allen was a person whose whole mission in life was dedicated to finding the truth. He read everything. He read the ancient Hebrews, the Hindus, the Buddhists, the Christians, everything. And I called the publisher one time because I wanted to get a bigger order to send to my clients. And he said, oh, Arnie, I only publish about 25 books a year on this. I don't ever get calls for that. I said, what do you mean? This book is so great. You only sell 25? I want to order 2,000. So they had a lousy cover and the type wasn't very good. So I made a deal with him that I would pay for all the publishing and so forth, and then he would get the profits, and I got the 2,000 books. If any of you are interested in that book, that's about as all-around book on philosophy, spirituality that you can find, and I would be happy to send you a copy because I have plenty of them for those who are ready to read it. We also emailed you a book list. Scott just reminded we emailed you a book list. So in that book list covers most of the books that I would recommend, including books on health.
Thank you.
You're welcome.
Hi, Arnold. Thank you once again. Just to echo what Timur said, we've learned a lot from your time and your wisdom, so we really appreciate you coming, or sorry, you not coming, but you speaking to us today.
It's my pleasure.
My question has to do with as a value investor, you have to be a contrarian. And it takes a lot of mental resilience to be a contrarian, especially in times where the market is going wild, like you say. How did you develop that resilience?
Well, you know what? I think that the resilience comes from how strong your desire is to achieve what you're doing. I noticed that in myself in a youth when I started out in my gymnastic career and I was climbing ropes and, I worked hard 2 hours a day for 2 years. And at that point, I wasn't even any better than somebody who'd never seen the rope and tried it for the first, second time. So that got me very discouraged. And there's something I can tell you that happens. And I think most of you who've struggled with something really hard, all of a sudden a flash comes to you and gives you an insight. And I think the more you struggle with the situation, the more you get that insight. And I got that insight and say, why are you going to quit? You're getting stronger. That's what you wanted to do. And I thought, yeah, that's right. So what happened is I went right back in there. And here I was one of the worst on the team. And within a year and a half, I became the school record holder and the league record holder. So what it taught me is that no matter how bad things are, and no matter how grim they look, and no matter how long it took you to get there, that isn't the way life works. You can work 2 or 3 years and show very little progress, and then all of a sudden you have a breakout and you jump geometrically. So you should never measure your progress by how hard you worked at it and just say, well, it took me 3 years to get there, so it's going to take me another 3 years to get there. No, it might have taken you 3 years to get there, and then in 6 months you make more progress than in the last 3 years. So that event taught me that no matter how bad things get, if you really want it, if it's not that important to you, that's different. But it was really important for me to be able to accomplish that. And so I stuck with it. And when I had a few experiences where I made a quantum jump, that's when I realized all you got to do is stick with it. The universe starts to back you. And I don't have the time to go into the details from a subconscious mind where that works for, but here's what I would recommend for the resilient part. Get something that you want so bad that you're willing to sacrifice anything that's reasonable to get there. Now, if it's at the first sign of hardships and you give up, maybe you didn't want it that bad. You got to decide how badly you want. And by the way, I wrote a speech in I think it was 18 years ago. No, 35 years ago. It was 1982. And I wrote an article about that very subject. It's called The Power of Commitment. And I sent it recently. I found it 6 months ago, and I thought, geez, this was pretty good. And so my wife and I edited it, and we're going to have it reprinted. But one of the pages in that book, I couldn't get the ending of how I wanted to end how you do this. And I just walked away from it. 2 or 3 weeks later, I woke up in the morning at 3:30 in the morning, and it was like somebody was dictating it. I only changed one word in the whole page. And I realized that the subconscious mind works on things when you're struggling with it, and then you get away from it, and then it comes to you. So the most important advice I can give you, find something you really want to do. Say to yourself, I'm willing to sacrifice these things for that, and just stick with it and develop the faith that you have within your subconscious the power to achieve anything you want to achieve. And there is a quote that I have in the handout on the philosophy. Did you guys get that quote? The quote books, and not the quote books, the quotes and the philosophy that I sent as an attachment to this program?
Ali says it's coming out tonight.
Oh, okay. Well, in it, I have a quote by Carl Jung. This is amazing. He said that if you contact your subconscious mind, you have the ability to not only learn everything you've learned in your lifetime, but you also have the ability to draw on the universe and reach and pull out information that has been learned throughout time. So in other words, all the knowledge that's out there is your subconscious mind has the ability to pull that. Now, when I first started reading that, I thought, how is that possible? Well, after I learned more about the subconscious mind, I believe it is possible. And let me tell you something. The latest discovery in neuroscience proves, and I have an article in there in that handout that you will be getting, that there's an article by a gentleman by the name of Joe Dispenza that talks about how accessing the quantum field gets you into a position where you can draw on all the knowledge in the universe. It's really fantastic. So I pulled a lot of my favorite quotes from the subconscious, and I think they'll help you build the resilience. But to sum it up, find something you really want, willing to pay all the price for it, stick with it until you get it, and it'll happen. That's how you do it.
Thank you very much.
You're welcome.
Arnold, can you talk a little bit about value traps? How do you identify or protect against value traps?
Yes, I've got a lot of experience in that. You learn a lot from value traps. I think that the value traps are those where you have a company that has gone down for various reasons. And I can think of one right now. And what happens to that company is they might have been a good company at one time. They might have been a leader in the field. But somehow or another, there is competition out there that may not be well known, but the competition's out there, and they're going to continue to work against that company. And I can think of right now, we own a company, our analyst Jim Brilliant discovered it. It's called Boom. It does things towards the, it does things in the fracking business, and it has developed a special pump that is so much better than the competition, and it does it cuts labor, and they're way ahead of the field. Probably would take anybody who's actually going after them 3 years. They got many things going for them. And when we listen to the conference call, there have been some companies in that field that have done a very good job. They've led the field. They're doing very well. And all of the stocks have gone down. But when we listen to the conference call on their competitors, they're not even aware of some of the advantages that that gun has, even though it's been out there and they've been taking market shares and so forth. So I would say if there's somebody in the field who is investing in one of their competitors, all their competitors are cheap. All the stocks in the oil service business are cheap. Some of these companies are very good companies and they have good balance sheets. And I think that over the long run, these companies are going to continue to suffer because their price has to go way down, and they've tried to do it through pricing. But what's going to happen is they're going to continue to lower their price. They're going to continue to lower their margin. They're going to continue to reduce their return on capital. And so these companies, which are decent companies and selling awfully cheap, and you would normally be attracted to them, you have to know that there's somebody out there that's got something going that might change the potential of those companies. And I think if you bought those companies now, I think you might get a bounce, you might get a mediocre return. But I think some of these companies are going to get in trouble. But looking at these companies, you could analyze them, say they're cheap on a valuation basis, they got good balance sheets, they've had good records, just that something is coming in the industry that a lot of people are not aware of. So one of the things that we always advise people to do, make sure you know your competitors as well as you do your company, because the competitor may be working on something that's not that apparent unless you really dig into the industry. And if you didn't see it, in the next 2 or 3 years, you could have a company that could become a value trap. Now, the companies could adapt. Maybe they could improve. There's a lot of things that they could do. I'm not saying they're doomed, but I think one of those companies could be a value trap. And it's not because it hasn't been a good company in the past. That's the trap. It's just like I always say, when you're looking at a quality company, is the quality going to continue? The whole secret is, do you have a competitive product? Now, if you have a product that's going to dominate the industry and is going to be that much cheaper and better than everybody else, then everybody else is a value trap. So,
No bear case.
huh?
What about knowing the bear case?
Oh, Scott reminded me the other thing that we always talk about. The other way to avoid the value trap is watch the short sellers. If you see a company that has very little short selling and everything's going along and all of a sudden the shorts are picking up, then you want to know the short case. You have to know the bear case of every company. So if you're watching a company and the short selling's going up, they're probably not any better in timing the short sell. But the fact that a lot of people are shorting the stock would want you to know why are they shorting it. So I always say, I want to know the bull case, but I also want to know the short case. And if you know the short seller's argument, and by the way, in fairness to the shorts, they usually are very thorough, they work hard, and they usually have a lot of good information. So in order to get a balanced view on your company, you should know the bull case, you should know the short seller, and you also watch the bond yields. In other words, what is the rating of the bond? I have a quote here by Benjamin Graham. Let me read it to you. I had it here. Well, I can't find it right now, but the quote is, those people who are very supportive, who are very knowledgeable about the balance sheet, like bond analysts, are the first to tell the deterioration in a company. So if you follow the bond analyst, their focus is just looking at, can the company survive, what is the risk, and so forth and so on. So between bond analysts and short sellers, you can find a lot of information to help you if you got into a value trap, why you should get out. In many cases, it helps you to avoid it. So the best way to avoid the value trap is to make sure that nobody else has got something. And you can do that by listening to conference call. You can see that the margins are depreciating. You can see that the return on equity is depreciating. When you call the company and say, how come your sales are down? Well, we had a little rough period, but, things are looking up again and so forth. But you have to know the real reason why things are slowing down. Sometimes they're legit and sometimes they're cover up. So being a good detective is the key to avoiding a value trap. But believe me, I've had my share.
Hi, Arnold. To build on George's prior point, we talk a lot about competitive advantages in class. Do you have any particular advantages that you're looking for? For example, technology, like you talked about earlier, and has your view on competitive advantages changed over time? And have some of the ones you've looked at previously you've realized aren't exactly advantages anymore?
Well, I think what George has said about the competitive advantage is so true. One of the things you learn about the capitalistic advantage, capitalistic system, free enterprise, even if you got a competitive advantage, competitors are always pecking away at it. So while you may have a competitive advantage one time, that can be eroded. And the only way you can do it is to keep always working on reducing cost, always work on improving the product, and always work on continually improving it. But sometimes people lose that competitive advantage, and then, like George says, it could turn into a value trap. So the most important thing, the way to keep track of their competitive advantage is a company that has a competitive advantage usually has a better margin. It usually has a better growth rate. It usually holds up better during times when sales are declining. It has usually a better return on capital, not necessarily equity, but capital. And it employs very conservative methods to be able to achieve that. If a company, grows faster, but they use a lot of debt, then, eventually that's going to be tracked. But let me tell you something. There's no easy way. You have to know the business. You have to understand it. And you have to watch the margins. I would say the return on capital and the margins, those are the things that will tell you whether that capital advantage is eroding or whether it's gaining. And the way you do it is you take that company and you compare it against the others. If every company is expanding their margin and your company isn't, Well, that's something to think about because you're obviously losing the competitive advantage. If one company keeps increasing the return on capital and the other ones aren't, well, that's a problem. So I wouldn't look so much at the return on equity. I'd look at the return on capital because sometimes people use capital to increase the company, but that wouldn't increase their return on capital because they got more capital employed. So it's the companies that have the high return on capital, it's the companies who can improve margins, and it's a company who can improve sales and gain market shares. Those are the ones that have the competitive advantage because if they didn't, they wouldn't be able to do it. Did that answer your question?
Yes, and I think another thought I had in mind was I think a lot of people like look for your answer was very holistic. I was more curious on maybe if there's something in particular you were like some sort of technology that or like something like technology because of like the recent developments in technology. Now you look at that sector specifically, and if you have any thoughts on some new trends that were developing that you hadn't seen before.
Well, that's something we're not big investors in technology, but we are very respectful of technology. Just to give you an example, there was a company called Advent that we used to have about 5 or 6 people filling out reports, and Advent came along with the 3000 program, and now we have much more work, and there's only a couple of people in the department with much more work. So software obviously is something that is a major competitive advantage. And this company's had a competitive advantage in there because they have the leading software for that particular industry. So we don't necessarily invest in the technology, but we are respectful of the technology. And when we see technology improving the value of our companies, then that's something we are obviously in favor of. So technology, if you're investing in the company, that's a different story. But to be able to use technology, that's really attractive to us.
Now is like the new advice, development in the AI and robo advisor, where I was very interesting in for you that you have mentioned a lot of psychology of the people and how that affecting actually the market. But how you find that robo-advisor is actually going to shrink the gap between the efficient market and the current performance of the market? Is the opportunity for value investment will still there if everybody's having a very professional, not biased and no emotional robo-advisor? And that might come in the next 5-10 years. How's your look to that? And one last question, once you finish that, is what can you give as small advice to new investors like our generations?
Okay, let's take the first one with the robot advisor versus everything else, right? When I just recently reviewed the performance of an individual who used nothing but technology. His name escapes me, but he's a physicist. He's had a tremendous record. He's even had a better record than Buffett. I think after fees, he averaged 40% for over 20 years or something amazing. And he's not a fundamentalist. He's strictly a mathematician, physicist. He's hired nothing but people like that. His name escapes me, but it'll come to me. So when I studied him, I realized that what he was doing is what we do, in a very laborious way of putting all the numbers together. So if you can use technology to do everything that we do, and you can get that information and it can be easier put together like a robot situation, that could definitely help the business. But it's be hard to see, and this is the first example of that, so I have to rethink it, but it's hard to see how you replace individual thinking, because let's take the robot that doesn't have the emotion. That's a positive. You don't get caught up in the crowd. You don't get sidetracked and so forth. But where does the robot develop the feeling and the intuition and the knowledge to be able to move into a stock when psychologically and fundamentally it's depressed? I don't think that the robot is going to be able to do that a great investor can do. I think that a great investor still has that ability to reason. And that doesn't mean that the robot can't do a good job. It doesn't mean that he might even be able to do it better than most people. But I think if you devote your time to studying the business, there will always be a place for you, because there's a lot of people that don't want to deal with robots. They need advice. They need somebody to sit across the desk with and find out what they should do, and advice and so forth. So robot can do the mechanical work, but it can't do the human thing. It's just like if you had a robot as a psychiatrist, how would that work? You know what I mean? So I think that there's always going to be a need for people to encourage people, to advise people, to give them good advice, to reason through their financial problems and so forth. So while that is an interesting area and it's something that I would look into, I don't think it's going to replace you as a person who takes an interest in people and want to help them and guide them and give them advice. Yeah, and so there's many things that need to be done by humans. For example, take the continuity of thought. How's the robot going to recognize that the continuity of thought has been broken? That's a pretty important thing to understand the psychology. I don't know at this point how good the robot is going to be, but after they do it for a while, we'll certainly be able to see, and then I think I'd have a better answer for you. Now, what was the other question?
So for a young generation, like what's your general small advice, like if they want to go like into investment, which direction, or like just general?
Okay, what I would do, and I was interviewed and I gave sort of the same question. What I would do is, if I was starting out as an investor, the first thing I did, I think I did that right, I studied all the great investors. I read their books. I read their philosophy. I used their thought process and the formulas, and I condensed it all down. And then I kind of made my own spreadsheet of checklist of things to look for and formulas and so forth and so on. And what I would do as an individual investor advising you, I would study all the great investors. I would study market history just like we did today. And then I would take a small amount of money, it doesn't have to be a lot, and I would use just a little bit in each stock to get the experience. So I say, okay, I've developed the methodology. This is the methodology that told me to buy this company. Depending on how much money you got, you can put a few $100 or $100 or $1,000, just to put something in there. Don't ever play on paper, because on paper it doesn't work, because it doesn't have any emotion. You got to buy the stock and you got to sell the stock. You can't just say, I bought it at 10 and sold it at 12 and I made a 20% profit on paper. You might not have made that profit if you'd have bought the stock and you say, geez, I don't know whether it's just selling, and all of a sudden it drops and you don't have a profit. So you have to experience that. So I would buy 50 to 60 stocks in 5 or 6 different industries, study the industry, pick the best stocks that you think it is, and then I would monitor them closely. And then if you look at the winner, you say, what made this a winner and what did I do right? Was I just lucky? Why did it go up? And then you got one that went down. Why did it go down? What did I miss? What mistakes did I make? Or maybe I didn't make a mistake. Maybe I should have bought more. So you follow this as a diary. It's kind of like if you're practicing to be an athlete, you practice the games before you get in played, and you learn what you do right, and you learn what you do wrong. And then you learn from it, and you will learn by experience. Just like, how did you learn to drive a car? They said, here's the brake, here's the gas pedal, here's the steering wheel, here's the ignition. Now, get in and drive it. And the only way you really learned is by driving it, not by reading motor manuals. So you got to do it to experience it.
Thank you so much again for sharing your insights. So I think you might have briefly touched on it, but this is more from my general curiosity. So if you were to go back in time at the stage when you were starting your career a few years ago, and having known everything that you know today, what advice would you give to your young self at that time?
Okay, that's a very good question. I would say that if you wanted to start your career, it depends on how much education you got. But I don't think I think there's a few things that you need to develop, whether you get a college degree or a PhD. Number one, you're studying business, you're investing in business. So the first thing you have to do is take any course that'll help you to understand business. And I would start with accounting. Accounting is the language of business. So I would take as much accounting courses as I could get to get the fundamentals of income statement, balance sheets, how people manipulate these things. And there's a lot of it going on even in the accounting firms. So I would become an expert at accounting. That's your basic. Okay. From there on, I would study the different philosophies and there's growth investors, there's value investors, there's people who are momentum investors, there's many different styles. One of the things you learn is not every style is always the best during any given time. I've always said that the ultimate money manager is like a decathlon track athlete. He's not the best in every event, but he does 6 events and then they tally up the score and he's the best in 6 events, even though he's not the best in any one event. So you want to become as broad and flexible as you can be. I think the great person to study for that is Peter Lynch. He is probably the most versatile investor. In his Magellan Fund, which he had a 29% performance for 13 years, he went from growth investor to value investors to split cap stocks to spin out. I mean, he did everything on the street. And so he always found the value. But the most important thing that I would do is I'd study different money managers. One of the things that I found out is people gravitate to the thing that makes the most sense to them. If you're wildly optimistic and you always believe the world's going to keep going on, you probably become a growth investor because those companies have optimism, they pay more, but they grow faster. And if you're disciplined in a growth investor, you could do very well. The other ones are people like myself who came through hard times, who saw hard times, and who realized that the most important thing is that you own value and you can stick with it and so forth. That's why it appealed to me during the 68, 74 bear market. So you study what style you are emotionally geared to do. You might want to be a growth investor, but when the PE start going up and the stocks start moving up and down, that might not be comfortable with you. So while you understand the philosophy, you may not be able to execute it because you don't have the psychological temperament for that. So the first thing you have to do is analyze yourself. Who are you? Where do you feel comfortable? Which style appeals the best to you? And the best style for you is the one that you can execute. Because if you're a value investor and you're at the bottom of the market, but you don't have the psychological makeup to buy things that nobody else wants, then maybe you won't be a good value investor because you don't have the psychological makeup to be able to do that. So you have to figure out who you are, what style fits the best. In any style, I would start with accounting, and then I would move in. And economics would be the last one I would study. Not that you shouldn't study economics, but one of the things I've learned about this business, you can be right about the economics and you can be dead wrong about the economy and the stocks. So by and large, economists aren't necessarily good stock pickers. They might be good economists, but they're not necessarily. So I would study economists, but I would study the industry, I would study accounting, I would study all the different methods of business and study business more than anything else, because the more you understand business, the more you're going to be able to understand the companies and the better you're going to be the appraiser. And then when it comes into the appraisal area, what I would do, and I forgot to mention that in the program, actually we didn't have the time, but I would study acquisitions. That's how I learned a lot about evaluation. There's acquisitions being done every year. Very few of them turn out very well. Most of the time, if it's a major acquisition, I usually sell the company because it takes years for them to consolidate, merge, and come out ahead. But I would study acquisitions for what they pay for a particular company. And I did this when I first came into business. I would read about an acquisition. I would pull the article and the value line or S&P sheet. I'd throw it into a box, and on the weekend I'd come and I'd run every metric, how much they paid for price to sales, how much they paid for price to book, how much they paid for price to cash flow, and then you get a feeling of what different companies pay for other companies. But let me ask you this question. If you had to pick an industry that you would really love to study and you really think you would enjoy investing in, which industry would it be? Do you have one that you would like now?
One that I'm particularly interested in is technology. That's one that I want to particularly know more and more about.
Okay, so what I would do is take all the technology courses you could, and you're probably doing that already, which would be a great thing. Learn everything about the industry. And let me tell you something. If you really get good at a industry and be able to build bigger positions in those companies, you don't have to go any further than that, because the companies that service the technology companies could be other companies that you can advise. If you know which is going to be the good technology company and which is going to be a leader in the field, they all have suppliers, distributors, and people they need. So by knowing the company that it's going to do good, you can analyze the different suppliers to that industry. Like take Apple. Just think of all the different companies that serve Apple. You could make a living just investing in Apple at the right price and then learning about their distributors and their suppliers and invest in them as well. So there's many different ways to go. But go where your heart is, go where your first love is, and commit yourself to that. You're going to be great.
Thank you.
Unfortunately, we're out of time. In 1 minute, can you summarize what is the most important thing you learned in life and investing over the last 40 years?
The most important thing that I've learned in life and investing, and I learned it through great struggle and the biggest conflicts I've ever had, is in seeking the truth. So I would say the greatest lesson that I can tell anybody here is make a priority to seek the truth, because only when you seek the truth and adhere to it and not fluctuate is when you can see yourself, understand yourself, and see reality. The problem with a lot of people is they don't see reality, and if you don't see reality, you can't make good judgment. So the single most important thing is become a truth seeker in everything you do. Not only will that help your intelligence, your judgment, and everything else, but it'll improve your life. I don't care whether you're an investment advisor or a doctor. Being able to seek the truth changes your whole life and your perspectives. It's the single best advice I can give anybody, whether you're going to be a doctor or an investor. So thank you very much. Thank you all.